In this video, we're talking about one of the best, in my opinion, tools in the toolbox or pieces of the puzzle when it comes to retirement and financial planning, the Roth IRA. I think if you know how to use the Roth IRAs well, it can be very valuable for you. You can start to look at the tax brackets and say, okay, how can I try to get myself in certain brackets? What about the tax code? How do I kind of use the Roth IRA in accordance with my other accounts? Is it right all the time for everybody? No, I'm a big fan of if somebody says always do this or always do that, I think there's more pieces that you need to look at there. Even though I like the Roth IRA a lot, there are rules and loopholes that are in it that you need to be aware of. Otherwise, you can kind of run into some issues. Today, we're going to look at 8 ways of planning with Roth IRAs to try to help improve your retirement planning. The first one, let's make sure we're on the same page with how Roth IRAs work, really, or Roth IRAs, Roth 401ks, really anywhere where you see Roth in there. With Roth, you don't get a tax deduction when the money goes in. If you put in $10,000, you're not going to write that off on your taxes. However, what it does is it gives you the opportunity to have it tax free in the future on what you put in and the growth on that money. So if you've been contributing to Roth accounts and you got a nice nest egg when you're retired, you've already gotten the government off your back. They don't get tax money on that. So I'm a visual person. So we'll look at it in this way. Roth IRAs, Roth 401ks, here's the tree, no tax deduction. You're not super happy that year because you don't save money on taxes. However, then when it's in the Roth IRA, it starts to grow and it's not taxed when it's still invested. What that means is, let's say you have dividends or capital gains, or you have a CD or bonds that would normally produce taxes to you each year. While it's protected in that Roth IRA, you don't have taxes. Then, when you're going to use it, say in retirement after 59 and a half is that special age that the IRS sets, it's tax free assets. So you're going to want, let's say you retire at 65, 67, and you say, hey, I want to spend $100,000. Well, there we might say, hey, let's take a certain amount out of your pre tax and pay taxes there. We're going to have Social Security, which depends on how taxes work there. Roth IRAs, okay, we're close to a tax bracket. Maybe we start looking at using Roth IRAs there. It can be a great way of saying, hey, no more tax, government. I already paid you. This is my money now. One of the unique rules with Roth IRAs that I find very valuable is that you can access your contributions at any age, penalty and tax free. It's a very unique rule with the Roth IRAs. What exactly does that mean? Most retirement accounts, you have to wait till 59 and a half to use the assets, or the IRS is going to charge you penalties and taxes. With the Roth IRA, if you've been saving for many years and you have accumulated 100,000, 200,000, 300,000 contributions, and the total balance is much larger, maybe you can access what you've put in without penalties or taxes. Let's look at this in a real world example. Maybe you're retiring early. It's pretty rare. Maybe you're in your 50s. You just have to save so much. Some people do. They save a large percent of their income. They want to retire at 50. Well, we somehow got to bridge that gap until 59 and a half so we can start using those contributions to the Roth. More commonly, this is somebody that maybe wants to make a career change in their 40s or 50s. They might take a pay cut, but they have been contributing to this Roth IRA. And they say, hey, I'm going to take a pay cut, at least for a handful of years, change careers. I'm just ready to make a change. We don't have access to all those retirement accounts. So unless they have a non-retirement account, which is not all that common where we have enough, we could say, hey, maybe you were making 100,000 and now you're going to make 50,000. Well, we need another 10, 20,000. Well, we have all these contributions to your Roth IRA where we can help supplement that income. So you change careers, you might make a little less, but you have access to this account. The next one is the 5-year rule. This is very valuable to know it. It's kind of rare that it impacts, but where it does, it can really bite you in the butt. Essentially, the 5-year rule is you have to have a Roth IRA opened and funded for at least 5 years until you can use the earnings, penalty and tax free. Even if you're over 59 and a half. It's a unique rule, and I won't get into why the rule is there. Let's say you have a Roth IRA and you're 58 and you just started it. If you're 62, it hasn't been open for 5 years. So even if you've been funding it, You can have your contributions, but the earnings, you have to wait for that fifth year. So, how do you get around this? We say open a Roth IRA as soon as you can. Even if you put a couple $100 in it, it starts the clock. It doesn't matter how much money is in there. You just have to have a Roth IRA of some sort for 5 years. After the 5 year rule, there are income limits with Roth IRAs. Why? It's kind of a bummer, but the IRS says, hey, if you make too much, we're not going to let you use them. There are loopholes that we can dive into, but let's focus on the rule here. In 2025, if you're single and you make over 150,000, you begin to phase out of being able to make a normal Roth IRA contribution. Again, what does a phase out mean? A phase out means if you make more than the number they give, so in this case, 150,000, they start to limit the ability to use that. And then once you hit the end of the phase out, you can't use it anymore. So single, if you make less than 150,000, you can make a normal Roth IRA contributions and you're good to go. If you're under 50, you can do 7,000. If you're over 50, you can do 8,000. If you make more than 150,000 until 165,000, you can make a certain percentage of the annual limit based on what your income is. So let's say you're halfway through the phase out, which goes from 150 to 165, you could do half the annual limit. If you go above the 165 in 2025, you're no longer able to directly contribute to a Roth IRA. Now, these numbers change pretty often, so each year you want to check it. Married filing jointly starts at 236,000, and then it phases out at 246. So if you're making more, you can't add to it. If you're under it, which most people are, these are very high earners. You can do a normal Roth IRA contribution. Just make sure if you're close to those phase out, you check your income those levels. Because if you don't and you're contributing and they catch you, the penalties can be not very fun. Now there is something called the backdoor Roth IRA, which is used a lot. Essentially, it's kind of a loophole to get around this. What you do is you put it in an IRA, you don't deduct it, and you convert it to the Roth. And I'll spare how that back office kind of end works. But the one thing that gets missed a lot is the pro rata rule. You have to know if you have traditional IRA money and you're doing a backdoor Roth IRA, the pro rata rule comes involved, which says, hey, how much is in your traditional IRA compared to how much are you converting? We're only going to allow tax free growth on the percentage of that. I won't dive too far into it. Just be aware if you have traditional IRA, you have to look at maybe I have to move that into 401k or convert that. There's rules there. One of the huge benefits with Roth IRAs are there's no required minimum distributions. If you're not at the required distribution, it doesn't seem like a big deal, but ask your grandparents if they're hitting them. They don't love those RMDs. With Roth IRAs, think of the rule. You already paid the government taxes, so they're not going to force you to take the money out to pay taxes because they already got their taxes. So if you have a Roth IRA and you're most time right now it's age 75, you can keep that thing growing and you don't have to take it out. So if you have estate planning or legacy goals, I want to pass this on to my children or friends or whoever, it can continue to grow tax free and it doesn't have to come out. Now, note inherited Roth IRAs have different rules. They do have RMDs and they do have to come out at a certain period of time. So this is your Roth IRA. Now, if you inherited it from somebody else, there are different rules. Then we move on to the spousal Roth IRA. Essentially, the rule with IRA accounts is you have to have earned income to contribute to them. Earned income, think of it like work. I get up, I go to work, I get paid, whether you're self-employed or you work for a company, that would be considered earned income. You have to have earned income to contribute and get these tax benefits for the retirement IRAs. Now, there's a rule though, if you're married and you don't work, so let's say one spouse is working, maybe the other's a homemaker or they're retired or whatever the scenario is, you don't both have to make the money. You can use your spouse's income and fund your IRA with it. Social Security tax effects with Roth IRAs. One huge advantage of the Roth IRAs is they don't count to your Social Security taxability. We can talk about how you have to calculate Social Security. Social Security is taxed at either none of it is taxed, half of it's taxed, or 85% of your benefit is taxed. Most commonly, if it's 85% of your benefits taxed. But there's a formula. You take your gross income plus tax-free income. So think municipal bonds. those are tax exempt at the federal level. Well, you have to add that back in. They force you to add that back in to calculate Social Security. It stinks, but they force you to do it. Then you take half of your Social Security benefit. Then you run your provisional income and see how much of your Social Security should be taxed. So if you have IRA distributions, pensions, those 401k distributions, those are income. So that would count towards your Social Security taxes going up. Roth money does not count as income. So if you take money from Roth IRAs, some from an IRA, some Social Security, or whatever your mix is, you could look at keeping yourself in a low enough bracket where Social Security is taxed at a lower amount. IRMA. IRMA's pretty rare. It's for people who have high incomes in retirement. A lot of times this begins to come into play when you have RMDs, and we didn't oftentimes think enough ahead on that. IRMA is income related monthly adjustment amount. You don't care too much about that long word. Think IRMA. It can significantly increase your Medicare Part B premium. So Medicare Part B, you have surcharges, which means your monthly premium is more the higher your income goes. Typically, it comes out of your Social Security check, so people don't really realize it. For 2025, it's $185 a month, but it can start to go up quite a bit. So the max is $628.90 a month. That's thousands of dollars a year. If your income and you're single is over 106,000, you can begin getting charged more for the same Medicare coverage. If you're married filing jointly, it starts at 212,000. So again, depending on where you live, how much you spend, you want to be aware because hey, if I'm pushing these and I still want more money in retirement, great, that's your money, take it. But maybe you want to look at using Roth for that extra portion instead of more taxable income so you don't run into IRMA. IRMA actually comes into play 2 years in advance. So a lot of people don't even realize that they hit that IRMA and they're going to get surcharged for 2 years. And then if they were doing it those years before, well, then they have that surcharge for multiple years until they even notice. So let's say 2025, you have too much income. You're not even going to know till 2027. So you did the same thing in 25, 26, 27. You notice in 27, in the next 2, 3 years, you have that surcharge before you're able to know what happened to change it. Roth IRAs, one advantage, they don't count as income. So that's where the planning comes into piece. Hey, how much do we want to spend? Great. You tell the number. How do we and where do we want to take the money from in accounts to try to avoid as much as this as we can? So your Roth IRA action plan, we talked about 5-year clock. That one's pretty easy to avoid. Just if you think ahead. Income limits, you don't want to miss those because they can get you penalized if you do miss those. Spousal IRAs is one that not everybody sees that can work. And then Medicare, you don't want to pay extra in Medicare when you can avoid it. Essentially, it comes down to this. We talked about a lot of pros and cons with Roth IRAs here. I think they're a very, very useful tool, but it has to be part of the overall plan. I'm not saying always use Roth IRAs. There's a lot of other good options too. So you're trying to make educated guesses and saying, okay, how can I pay the least amount in tax? Is that now or is that later? What bracket am I in now? What will my bracket be later? And also the trick there is what will tax policies be later? We don't know what taxes are going to look like 10, 20, 30 years from now. We do know what they are now, but maybe you're making quite a bit of money and saying, hey, when I'm retired, I'm going to be in a lower bracket. Well, then, yeah, maybe we don't want to use the Roth IRA there. Maybe you already have a lot of Roth IRA money. Or, maybe I have legacy goals. Like this wants to go to my kids or whatever. Think of it as all in one. Roth IRAs, what else can I tell you?
Let's make sure we're on the same page. This is general educational info, not personal advice. We don't know your goals or financial situation. Before making any decisions, it's always recommended to talk to a qualified professional who can tailor guidance to your specific needs after learning more about you. This information is not intended to be a substitute for specific individualized tax or investment advice. Securities offered through LPL Financial, member FINRA/SIPC. Investment advice offered through Harborfront Financial Group, a registered investment advisor. Harborfront Financial Group and Custer Financial Advisors are separate entities from LPL Financial. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Harborfront Financial Group, DBA, Custer Financial Advisors, CFA, is a registered investment advisor. RIA, registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. Custer Financial Advisors renders individualized investment advice to persons in a particular state only after complying with the state's regulatory requirements or pursuant to an applicable state exemption or exclusion. All investments carry risk, and no investment strategy can guarantee a profit or protect from loss of capital. Past performance is not indicative of future results. Advisory services offered through a Harborfront Financial Group, CRD number 331763. A Roth IRA conversion, sometimes called a backdoor Roth strategy, is a way to contribute to a Roth IRA when income exceeds standard limits. The converted amount is treated as taxable income and may affect your tax bracket. Federal, state, and local taxes may apply. If you're required to take a minimum distribution in the year of conversion, it must be completed before converting. To qualify for tax-free withdrawals, you must generally be age 59 and 1/2 and hold the converted funds in the Roth IRA for at least 5 years. Each conversion has its own 5-year period, and early withdrawals may be subject to a 10% penalty unless an exception applies. Income limits still apply for future direct Roth IRA contributions.